Today is April 4th. The market this morning is down about 4%. It's following yesterday's decline of 4% or more. Many of us, myself included, human like everyone else, the market action of the last few days has been a little nerve-wracking, a little unsettling. But one thing I have learned over the years, and the people that I pay most attention to are those that say it's temporary. Things like this have happened frequently in our past. It's always different, maybe in terms of the cause of a market sell off, but the result has always been the same. The market goes up eventually. And so I thought it might be a little helpful, hopefully a lot, if we reviewed all 15-year market periods since 1945. There are 64 of them. So if we take every 15-year period, rolling period from 1945, I thought it would be interesting if we looked at the results to try to put the present pain and suffering that we're going through in some longer term perspective, to try to highlight the opportunity in every market, especially during those markets when we're experiencing a sell-off. So if we go back and we say, what was the minimum annual return? The minimum annual return for 15-year rolling period since 1945, there have been 64 of them. The minimum return annualized has been 4.34%. 4.34%. That's the worst over a 15-year period. So what was the maximum? 19.5%. What was the median? 11.2%. And what was the average? 11.72%. Now these are 64 different 15-year periods from 1945. So I think the people that we like to pay the most attention to, and when we're going through nerve-wracking times like we are currently, I've learned myself, and from talking to other people, I wish I knew then what I know now. Well, this is what we know now. And I'm asking all of you to go back, try to remember all those terrible times in your life. And if you're older than 80, that would date you prior to 1945, you've got that many more tough times, bad times to have experienced and to relate to. So think about that for a minute. All those times, the pandemic, the financial crisis, World War II, Korean War, the Kennedy assassination, the assassinations that occurred during that period in general, the recessions, the near depressions, all of that, and say the worst I would have done using the S&P 500 as the measure, the worst would have been 4.34% over a 15-year period. And I like to say that if we look at a long-term chart, I sometimes will ask people, well, look at that chart. Tell me when you would not have been invested. And the longer we stretch that out, the periods when the market declined don't really show up very much on those. But in the moment when they're occurring, as the present time with fears over tariffs and the potential for a recession, they are incredibly painful. And we frequently think that this is the beginning of the end. And we start worrying about things. And sometimes we even come to conclusions. Well, the only reasonable conclusion to come to, based on 15 years, is you've got to own, and if you're able to, buy stocks. Some of you may say, but my time frame isn't that long. It's 10 years, it's 5 years. Well, I understand the fear and pain that you feel if you're in that uh, situation. But I would still say that no matter what, the best thing to do is to hold. And if you're considering or uh, looking at a change in risk tolerance, you don't do that on the way down. You do that on the way up. You do that when you're feeling good. And quite frankly, the reason why I've found many people don't do it when they should is that sometimes we get a little greedy and we say, well, we'll put it off. We'll delay it. Well, that's okay. I'm a long-term investor. I'm what I'm suggesting to you is going to be more conservative than in my own case because I don't own any bonds. I am always invested in stocks or more aggressive investments like real estate. So, if you're at that point where you wish you had made a modification to your risk tolerance, risk strategy, this is probably not the time to make a major adjustment. A 5 or 10%, 15% adjustment, maybe that's reasonable right now. But to make a major adjustment, selling out of the market, making a major reduction in the common stocks you own, we would urge caution in making a decision like that. Stay true to your course, which had previously been established. Don't get frightened out now. Look at the long term history. Look at those 15-year rolling periods I just mentioned and take some comfort in knowing that if we can stretch this out, the longer we can stretch it out, things are likely to look a lot better. The other part of this is that we don't really know what's going to happen. This market could turn around very quickly and go up. It may go lower. It may go a lot lower, and it may go a lot higher. The truth is, we do not know. No one knows. But what we do know is when we commit and stay the course, the kinds of returns that I just cited in those 15-year rolling averages become much more likely than if we start to make adjustments in what we're doing. So I plan to make these talks available to you over the next few weeks, hopefully, but as long as it takes to get us through this period of volatility that is frightening to all of us. I plan to continue to do these audio presentations and hopefully to give you some insights and looks at the market that will help you cope with the present day events. Thank you for listening to this. This is Tom Curran. Bye.